Hello, this is John Gilbert at Security First Asset Management with a weekly market update. This weekly market update will be covering the first week of September. That was last week. Now, a few things that I wanted to touch upon briefly before we get started. We have had change to our event calendar. So some of the events coming up, the dates have changed on those. So keep an eye out in your email or give us a call or check our website to see the most up-to-date event calendar. Alright, so moving on into the market news. Last week, all three major US indexes finished the week lower. And so this is for Labor Day. Last week, Labor Day happened. So markets were only open 4 days. That was Tuesday to Friday, September 3rd to 6th. Now, in that time, the Dow Jones Industrial Average dropped 2.9%. The S&P 500 dropped 4.2%. And the NASDAQ dropped 5.8%. So we saw some significant drops in the market. Now, the S&P, the 4.2% drop it experienced was the worst weekly drop in 18 months. And so that there are some worries over an economic slowdown, and that appeared to weigh on consumer sentiment. Now, we're entering a seasonally choppy period for markets. So September and October historically are a bit more of a rough time for markets. That combined with US elections in November have kind of given place to a little bit more uncertainty in the economic and political environment. And so it wouldn't be surprising to see some increased volatility going forward throughout these next few months. Last week, the sectors that outperformed the most were consumer staples and utilities. Both of those are considered defensive sectors and they hold up well in times of an economic slowdown. Now let's turn our focus to the labor markets. So the US labor market was a key point of focus for investors last week. Overall, the jobs report confirmed signs of a weakening labor market. Now, having said this, the unemployment rate still remains reasonably low, well below the long-term average US unemployment rate. Markets are now turning their attention to the Federal Reserve and how the recent softening in labor markets combined with softer inflation data, how that could impact potential interest rate cuts. Now, the Fed is meeting in September, and so they will be announcing September 18th whether or not they're going to be doing a 0.25% rate cut or 0.5% rate cut. It's still looking likely that the 0.25% rate cut is going to be what they do. However, that could change in the upcoming weeks, just depending on the current market conditions and other reports that will come out in that time. Now, with the expected rate cut, we have seen Treasury yields across the board move lower. Notably, the yield curve has disinverted, and so for a long time, the 2-year Treasury yield was higher than the 10-year Treasury yield. Historically, when this happens, that is kind of pointing to that there's going to be rough times ahead, that some bad things might be coming. Seems like we may have escaped that this time around, and the inversion of the yield curve tends to occur as the Fed is poised to lower interest rates, and when the economy is softening, which will be happening here soon. So that is all for the weekly market update. Thank y'all so much for watching. Have a good day, and y'all take care.